Real estate exam financing and mortgage types. Complete breakdown for 2026. Financing is the highest weighted section on the real estate exam at about 14%, accounting for 17 to 20 questions. This is where most candidates lose points. First, the terminology trap. The mortgagor is the borrower, and the mortgagee is the lender. The exam loves testing this because it's counterintuitive. There are two main security instrument systems. In lien-free states, the borrower holds the title. In title-free states, the lender holds the title until the loan is paid off. The four main loan types are conventional, FHA, VA, and USDA. Each has different down payment requirements, insurance requirements, and eligibility criteria that are heavily tested. Here are the four loan types compared. Conventional loans require 3 to 20% down. If you put less than 20% down, you'll pay private mortgage insurance or PMI. Once you reach 80% loan to value, PMI can be removed. FHA loans require just 3.5% down, but charge mortgage insurance premium, or MIP, for the entire life of the loan if you put less than 10% down. VA loans offer zero down payment with no PMI at all, but they charge a funding fee and are only available to eligible veterans, active military, and surviving spouses. USDA loans also offer zero down payment for rural properties only, with income limits based on area median income. Key formulas to memorize. Loan to value equals loan amount divided by property value. Equity equals property value minus loan balance. Debt to income should be no more than 43% for most loan programs. Federal lending laws are also heavily tested. RESPA, the Real Estate Settlement Procedures Act, prohibits kickbacks and requires a loan estimate within 3 business days and a closing disclosure at least 3 business days before closing. TILA, Truth in Lending Act, also known as Regulation Z, requires full disclosure of loan costs, including the annual percentage rate or APR. It also gives borrowers a 3-day right of rescission on refinances of primary residences. ECOA prohibits lending discrimination. Know the difference between the primary and secondary mortgage markets. The primary market is where borrowers get loans directly from lenders. The secondary market is where Fannie Mae, Freddie Mac, and Ginnie Mae buy and sell these loans. Ready to master real estate financing? Visit openexamprep.com for free practice questions and study guides. Everything is completely free.